With that, it is now my pleasure to introduce our speaker, Henry Shen. Henry is a senior investment strategist within BlackRock's Systematic Active Equity Group. He's responsible for growth of the group's investment platform with primary focuses on China A, Asia Pacific, and global equity strategies. Please welcome Henry Shen.
Great. Good afternoon, everybody. It's a pleasure to be here. Hopefully everyone stays safe, wash your hands often, and best of luck in this uncertain times. So I think the topic today is all about China. We're going to kind of elaborate a little bit through global equities, kind of the macro perspective, and then drill down into how that affects China. And certainly we have a bunch of insights using alternative data sets gleaned through the Asia markets and see how that affects kind of downstream to investment opportunities within the Chinese equity space. Just a little bit about what my team and what I do here. We use big data, machine learning, alternate data techniques to generate alpha for our clients. Our platform overall is about 100 billion. We've been doing this for about 30 years. Obviously, the techniques evolved over time. So we've been intensively using these type of techniques for alpha generation in the last, I would say, 10, 12 years or so. So certainly, it's a good time to do these type of strategies. And you see a lot of these type of volatility coming through at play, especially on a year-to-date basis. So kind of three key sections really go through what the global backdrop is. Certainly you think about growth edging up. You see the ebb and flow of uncertainty, really driven by thinking about geopolitical tension, thinking about coronavirus impact on growth and earnings and business sentiment, and how do central banks and monetary policies, fiscal policies respond to that. So that's kind of the global backdrop, really quickly covering that. And then we transition to China macro policy and the outlook on the overall economy. So think about how the 5-year plan will be deterred or altered in the face of coronavirus impact. I think still a lot of structural opportunity sets. And actually, if you compare just looking at year to date or since January 25th, since the outbreak, you compare the equity returns between emerging markets and China A-shares, there's roughly a 14% spread. So A-share has done relatively well, relatively resilient in the face of all this outbreak, and there's quite a bit of kind of attribution breakdown explaining why, and I think it's quite interesting. We'll get into that in a bit. And lastly, really about investing in A-shares. It's probably once in a lifetime opportunity where you get the second most liquid market in the world opening up to global investors around the world. It presents orthogonal opportunity sets. So, it's a great opportunity. So thinking about how we approach this market is kind of the last section. Is really the meat of the content where I'm going to focusing on today. So quickly, where we get in the cycle, certainly late stage. The graph here. This is using a similarity measure through a machine learned technique. We're using about 20 different macro and market indicators as a feature to train what the market is today compared to every single day in the past, and looking at distance to similarity. So the distance will indicate how similar it is I am today from every single month in the past. And you can see I've highlighted in the blue boxes here, the fourth quarter of 19 is pretty similar to you can see the late 90s, the early mid 2000s, right before the crisis, and that's kind of the environment where we're at today. And I think the way I'm showing these charts is if you look at the darker the shade of blue, the more similar it is today's environment to that particular period. So I'm showing quarterly basis here for each of the blue bars or each of the bars here, and you'll notice a particular white swath, and that's obviously the Great Financial Crisis 2008, 2009. You'll see a period of kind of just complete white. So it means it's completely dissimilar to any period we've observed in the past market. So this is typically we use this as a gauge for a continuous measurement of market similarity for us to do style tilts and style time exposures in our investment strategies. So certainly this corroborates many strategists, many people's view that we're continuing running towards a late stage cycle, and that's being, I would say, persistently kicked down a can kick down the road in terms of kind of injecting more policy, injecting more support measures to see how far we can go in this particular cycle. From a monetary and fiscal perspective, on the left-hand side here, we're looking at a natural language process view across a variety of sell-side strategies. So looking at kind of keywords that mentioned for specific countries. So all the green dots represent specific countries' monetary stance, and then your y-axis is looking at the start of 2019 versus the x-axis is start of 2019 versus the y-axis, which is the end of 2019. What are my shifting in views across different countries' monetary policies? So your the slope equals 1 here is kind of the comparison point. So if you are to the bottom or right-hand side of that slope, it indicates you have a more easing stance across your monetary policy. So you can see majority of countries continue to ease towards the way. And if I kind of compare that to February, March 2020, that divergence further expands in terms of global economies furthering their monetary stance. I mean, you think about further rate cuts that's occurring for the U.S., and that has global implications in terms of how that will impact the emerging market beta, the expectation for funding for Chinese Chinese banks, as well as the RMB appreciation and strength. So I think that actually, from an Asia perspective, the continuous easing portion will be a support, will buoy overall the base case for our Asia market assumptions. Now, from a right-hand side, this is looking at fiscal sentiment. Again, this is instead of using machine reading techniques and read through all the various sell-side reports and extract the sentiment there, we're looking at a number of different kind of I would say fiscal publications, and then we're using that as a measure for fiscal support here. And so you can see, again, I would say overall, after a series of downtrend in the late 17 through 18, you see continuous fiscal support throughout major economies here. So I would say overall, you've been continuous getting more support, and I think compared to where the profit cycle, business cycle is, I mean, this is just looking at U.S. for example, but this illustration, I would say, apply for many corporates around the world. I think profit margins definitely been declining overall, but I think earnings growth also has been quite stale, especially in 2019. So where's equity returns coming from? Certainly a little bit of that dividend yield will play through, but most of it is also re-rating and multiple expansion. Our base case for the continuation of a strong equity market for this particular year and actually going forward is we need to see some level of earnings growth, and that may not happen with a persisting failing or declining profit margin, right? So that's a little bit of why you see a lot of these monetary and fiscal policies playing through, is to help kind of corporates become a little bit more profitable than the series past, which they haven't really been, I would say, in aggregate since 15. Or I would say it's an aggregate they haven't, but the dispersion is quite high. It's really focused on high growth companies, which also explains a little bit of why that huge divergence between thinking about growth factor versus value factor, that divergence has occurred since the late 2019 or late 2018 and has persisted through even to today. And lastly, I think from a global perspective, there's certainly a lot of geopolitical events that's occurred in the last, call it, 18 months or so. Certainly have been very, very, very eventful. So we've listed a couple of here. This is our kind of global level geopolitical dashboard, and your y-axis is kind of standardized score on level of riskiness from a geopolitical global scale, and we use this as a way to dynamically trim our equity beta exposure towards specific country risks, right? And so for this particular case, You can see in 2018, since the start of the U.S.-China trade tension event has occurred, it really has went through a very bumpy, heightened roller coaster ride. And just when the phase one deal has passed earlier or late last year, early this year, with a lot of expectation on that kind of cascading through a resumption of, call it China export, resumption of growth for many Chinese equities, you get a number of unfortunate events, which I would say front and center is the virus case, and so we do see geopolitical risks declining a little bit. I mean, you do see the oil fight being front and center. That's going to trigger a little bit of volatility in this particular index, but overall we do see geopolitical risks declining a little bit as other issues take front and center. So that's a global backdrop. Now moving on to China specifically, you can think because of the start of a trade war since late 18, couple that with the COVID-19 impact, definitely in material impact of overall China GDP growth for call it 19 and 2020 going forward. And this is confirmed by, we do use a number of alternative data sets. This particular case, we're using satellite imagery, and we're using that to shine through specific publicly listed equities, factory locations or mining locations, real estate development sites, and that's been a kind of directly supportive of a declining growth. And I mean, I think this one particular is just cutting through PMI indications on the right-hand side, but certainly you see a huge decline with both the service level PMI, which is Caixin PMI, as well as the manufacturing PMI, both recording record low levels, as the coronavirus take hold. But I think from an investment opportunity perspective, if you can get a better and faster read on, say, okay, how quickly are people resuming to work? There are many proxies. For example, coal output and pollution is a more direct way people can directly measure to see whether industrial outputs has recovered. That's one way to see, okay, how quickly has the economy resumed, has production resumed, has factory to start building, rebuilding their inventory for further consumption. Exports will continue to be a drag for this particular year, and I think what we wanted to chart here on the left-hand side here, this is export by particular destination. I'm just listing U.S., Europe, and the ASEAN countries. You can see a clear kind of precipitous drop for the red line here, which is the U.S. Really, that's directly impacted by the trade tariffs and trade restrictions imposed by the U.S. But I think picking up the slack really is a lot of heavy exports to Malaysia, export to Thailand. Even Korea and Taiwan has been a net beneficiary on China exports, receiving these exports as well. I would say Europe has, de facto maintaining pretty weak export. I would say export figures from China, mostly because of a weakening macroeconomy around the Brexit situation. You think even with all these declines in export figure, this is a 12-month year-over-year measurements. You look at the right-hand side here, the G3, so which includes the Eurozone, US, and Japan, still accounts for about 40% of the overall, export reliance for China. So, definitely a drag that will continue to play out this year, especially as a resumption of industrial activities on import-export activities remain slow, especially given the viral impact. I think this will be a continuous drag on further on overall the GDP and growth print for China. That being said, because of that, I think China has been very proactive, and market is pricing that in terms of its fiscal response. So you can see left-hand side is the number of fiscal kind of deficit responses by breakdown. So there's certainly a lot of, I would say, special credit lending that's being issued out to support banks, to support small, medium enterprise businesses within China. So that's a direct kind of response on government's side to help support the overall economy in the wake of the virus impact. Now, thinking about other policies, how it might work, what we typically do is every year in November, there's the kind of NPC, National People's Congress meeting that will set the agenda that Xi Jinping and the party wanted to do for the overall economy. And now these are kind of I would say this is the de facto direction that has been the case since 2018, which is really on these key measures: supply side reform, SOE, state-owned enterprise reforms, environmental protection, deleveraging of its financial system, and the One Belt, One Road, which is an infrastructure initiative for overall China. And we do monitor, since the NPC will direct a number of key policies, and what they'll do is Xi Jinping likes to repeat many of its key focuses on the national people's daily newspaper. So this particular state-owned newspaper is called People's Daily, and what we do is we track the number of times all these key policies are being mentioned as a way to see what's the eventual realization, what's the actual focus of the government here. So you can see as the trade war occurred in 2018, this is looking at the left-hand side chart here, a lot of the front and center focuses, whether it's environmental protection. Actually, we used to have One Belt, One Road. It just completely fallen off in terms of number of mentionings here. Dropped, like alongside with supply side reform that dropped, replacing with some focuses around technology, IP protection, 5G infrastructure. And then you also see a lot of these newly emerged policy focuses to help combat, I would say, the business negative drag overall for the economy. For example, big focus on tax cut last year, which actually hugely helped a lot of corporates with their profitability. A reliance on financial deleveraging. A lot of stance, I think, earlier in 2019 is if you were going to get a hit on overall growth figures, you might as well take the opportunity to steer clear of any of the shadow banking issues, any of the over-bloated credit environment that the economy has set up. So it was a great opportunity for kind of Xi Jinping to kind of get rid of the bad stuff and kind of refocus and reshed in new light. So I think this is continuing to play through. I would say even bigger focus this year around technology development, around 5G infrastructure. I would say in tandem, there's been a refocus around environmental protection, and certainly healthcare reform is a new particular stance that has taken up. I would say not really because of the coronavirus, but certainly it lead the coronavirus situation by, I would say, a quarter or two. So there are a number of interesting policies that's been setting up from China, from kind of subsidizing heavily on medicine and pharmaceuticals to supporting a lot of the, I would say, R&D efforts for many of the private and public healthcare companies here. So that certainly is a big part of the focus today. From overall comparative perspective to the U.S. versus China, I mean, you can see it's certainly trying to catch up and challenge many aspects of the U.S. focus from the technology and innovation perspective. So I think thinking about knowledge diffusion, thinking about R&D development, thinking about knowledgeable workers, so focus around trade, competition, market scale. These are definitely, and innovation, these are definitely, I would say, on par from the level of focus and level of money being pumped through in China, supported by Chinese government, to the U.S. So that certainly is something, and I would say underpinning bipartisan issue from the U.S. side to address one of the key cornerstone of why the trade war was started is to address a lot of these IP issues. And I would say definitely we see material improvement in IP leakage in 2019 from kind of the China side in terms of kind of what's it called from like actual output of products in terms of the kind of IP leakage perspective. So that's kind of the macro backdrop from a global and China perspective. Now moving on to A-shares itself, which is really kind of what I wanted to get into the topic today on equity investment in China A shares. Now, on the left-hand side here, you see this is a full 100% inclusion of the MSCI Emerging Market Index. You'll see a dark shade of blue that says China, and then you'll see a lighter shade of blue that says China A. So at full 100%, China A will represent about 17% of the emerging market index and bring the overall China exposure to just over 40%. And now there's a great difference between China and China A. China are typically stocks, so you can invest today directly through ADRs or through the Hong Kong market. So these are names that are well known to everybody here. Think about Baidu, think about Tencent, think about Alibaba. These are the big names that you would have heard about, and that's existing, that's been existing in your index for a long time. China A are the stocks that are domiciled in China and listed and traded in China, specifically in the Shanghai and Shenzhen stock exchanges. They typically, historically, have been inaccessible to any global investors, with the exception of a select few where you need to obtain qualified foreign institution investment quotas, QFI quotas, to invest in. Now, since 2017, through these programs called the Stock Connect program, the number of access has drastically improved and drastically increased. As such, MSCI, FTSE, and many index providers around the world have started to allocate more weight into the China A shares market. And that's I would say pretty pertinent, and that's what I meant by this is the second largest untapped market in the world, where you used to have close to 0% of foreign investor ownership in that market. You're going to increasingly see an uptick from 0 to 1 to 2 to 3. Eventually, you're going to see 5, 6, 7% of foreign ownership in this space. Now, to put in perspective, this particular Asia market is roughly $8 trillion in market cap, which is tremendous. And thinking about the correlation structure, on the right-hand side here, this is the China A-shares equity index compared to a variety of different equity index around the world. So relative to S&P 500, this is looking at the 5-year trailing correlation, 35%, to developed markets about 40%, to emerging markets itself 50%, and to even just kind of H shares, so China index, so companies are listed in Hong Kong versus those are listed in China, the correlation is only about 60%. So certainly a huge diversification benefit for global equity investors. And you think about the overall revenue exposure, a lot of these companies that are listed in A shares, they're heavy on consumer staples, heavy on consumer discretionary, heavy on industrials. What they're focused on is really domestic consumption. The revenue derived, I would say 90% primary revenue source, domestic China. And so you think about where Chinese economy is going to be turned into a more consumption-led economy and consumption-driven economy. A shares get that direct exposure, whereas you look at many of the companies, Alibaba, Baidu, Tencent, they're actually multinational, where a big part of their growth story is I'm going to go international. I don't want to just derive my revenue source from Chinese customers. I want to go to the globe, whether that's in Latam, whether it's North America, or whether that's in Europe. Couple points around valuation sentiment. Certainly, I was just speaking to one of the guests earlier today, from a relative valuation perspective, the forward price earnings ratio for A shares at this particular junction is actually quite low relative to history. It always commanded a slight premium over China, which is the H shares, as well as emerging market players, mostly because of inaccessibility, mostly because of the lack of direct, I would say, substitution. But I think where we are today is still relatively cheap to history. I think it's also important to note from a equity return perspective, A shares is extremely volatile, where you get roughly 28-29% volatility year over year. So think of that as a 30% premium relative to emerging markets. And actually, historically, it hasn't been the best risk-adjusted profile or market for investors. The Sharpe ratio is actually supremely low over time. So that brings a case to why you need active strategies in the A-share market. Now, from a sentiment perspective, on the right-hand side, this is measuring the northbound stock connect program I mentioned a little bit earlier. Since 2017, there's been these series of programs that allows investors to open an account in Hong Kong and trade directly through Hong Kong and link into Shanghai or Shenzhen to get A-share exposure. That's actually predominantly how the majority of investors today are trading and gaining access through A-shares. Now, you don't get the full universe access. You get roughly 1,600 stocks of access today, but that list is expanding as we speak, and hopefully at some point you'll get the full access of the Chinese equity markets. But inflows to China A-shares continue despite a lot of these trade dispute, a lot of these concerns. Now, what's interesting is if you look at, if I continue this line, and I'll, the later part of this presentation have much updated information, but if I continue this is as of December 31st. If I continue this to March 6th, or last weekend, or yesterday, what's very interesting is on the first day of market resumption on February 3rd, when Chinese equities declined by 9%, we recorded the most ever net inflow from foreign institutions northbound in stock connect. So it's certainly a diverging sentiment in the sense that initially retail people are super scared, super hesitant, and very risk off in the face of the coronavirus outbreak, in the face of what are the uncertain impact of the overall economy and all the underlying holdings earnings. And then they all sold off, and then foreign investors actually came in and supported and buoyed the overall market initially. And then you'll see a little bit of switch, which I'll speak to in a bit. Couple other interesting points here. Oh, and I think just to highlight here, if you kind of plot out the delta, which is in U.S. billions in the y-axis here. So net you see over $200 billion of net inflow from foreign investors since the start of the program. We've recorded just shy of about 100 billion last year from the northbound stock connect program. So certainly a lot of asset pushing in, and just from passive, it's just like the index factor inclusion. I mentioned on earlier this page, at full inclusion, 17% for A-shares. Right now, we're at a fifth of the inclusion factor, which is at 4%. So 4% of all emerging market investors that are benchmarked to MSCI EM will need to have China exposures, and that alone amounted to about 60 billion of inflows just from a passive perspective, and a lot of obviously active money sloshing in and out in between. And I think a couple interesting perspective on the left-hand side here. This is plotting the CSI 300 index, which is the green line, and that's really the local A-share market. It's there's another index provider that's very widely used onshore by retail investors and local investors. And compare that to the red line, which is the margin financing balance, and it's basically the amount of leverage or credit retail investors has borrowed out to participate in equity trading. And you can see it typically has gone hand in hand with the Asia equity markets. You see, I think I've listed out here this huge spike. This huge spike here. That's typically that was the retail frenzy followed by a subsequent crash in 2015. So 2015, there was a huge amount of retail investors borrowing money and participating and putting their entire life saving in these highly volatile equity markets. And you see a market just shooting up by over 100% in 3 months, and then subsequent crash by 50%, really within the span of like couple weeks. So that was the last time it had this huge kind of, I would say, leverage issue, financial leverage issue on the retail credit perspective. So there's been a lot of concerns around constraining the number of leverage, number of credit retail people can take out for equity investing. And you can see clearly the government has done a good job in the sense that in the rally in 17 and as well as the rally in 2019, there's been very little kind of strong direct link with the number of margin financing increases. So that's I would say a hallmark of a more stabilized financial system. It's certainly getting more regulated, but it's certainly also getting more transparent in the sense that it's allowing for multiple investors' participation in a fair and sensible way. Right-hand side, I think, is a It's another very interesting perspective. It's also another alternative database insight that we have. So I mentioned retail investors is a huge part of, I'll get back to that chart in a bit, but retail investors is a huge part of the A-share market. On the right-hand side, you see here, this is an A-share equity market ownership structure where we see over a large part of this chart is yellow, and that yellow is classified as domestic retail unclassified investors. Basically what it is folks like you and me sitting on this table here, or you're along with your friends and family, your mom, your dad. They just love to trade, love to open accounts and trade. It's a national pastime. Growing up, I used to go to these stock sites where I would say stock posts where it was just like a wall of TVs flashing green and red. I went with my grandpa, and he would be like, "All right, we're betting today." So it's, there's very little legalized gambling aside from Macau in China. This is their way to get access. And I can tell you, retail investors, they don't do value investing. They don't care much about fundamentals. There's some, but it's really rumor chasing and like momentum and reversal effects in that space. So understanding how they trade is extremely important for alpha generation in A-share market. And this on the right-hand side on page 17 here, you can see this is as technology and people progress, people instead of going to these stock post sites, they're actually going online and participate online on these very famous blog post websites, and there'll be millions of views and millions of posts. Well, actually, technically, it's millions of posts and tens of millions of views every single month, talking about what stocks to buy, what stocks to sell, what rumors has occurred, and people actually, there's been, the empirical evidence has drawn to kind of just follow these kind of sentiment on retail posting on these sites will be a great kind of investment strategy. And so what we do here is we're showing the number of posts. This is a rolling average on one particular site, and you can see, it reached new highs in December 19th. But if I actually draw this out to March, to like today, it's even higher. And why is that? It's because everyone's quarantined at home and they got nothing to do. So what are they doing? They're actually actively trading online, which actually explained the dispersion of that 16% dispersion between emerging markets and A-shares, as people, were trading based on rumors of, there's going to be more government stimulus. They're going to focus on specific subsets of the A-share market that seem to be less impacted by the coronavirus. So it's really another very narrowly driven market where a subset of 50 out of 4,000 public listed names are leading the overall equity market and supporting overall market returns. And so it's like one of the fascinating points of A-share structure. Now, I mentioned there's quite a lot of difference between A-shares and H-shares, which are offshore names. There are about 80 names in the indices that overlap. So think about Bank of China. They have one that's listed in Hong Kong. They have one listed in Shanghai. They don't trade at the same price. So but they have exactly the same fundamentals, right? It's exactly the same company. It's just axes are slightly different, and they're owned by different people trading based on different assumptions. So there's this AH premium that will occur, and it will fluctuate over time. And you'll see, as external geopolitical risks occur, like thinking about the protests that has occurred in Hong Kong, thinking about where Hong Kong would stand as a financial center for the world. That certainly has caused a lot of decline in H-share expectation values, and as such, you see a huge increase in the overall A-share premium relative to the H-shares. So that's a very interesting kind of play. So if you're looking at greater China investment strategies, where you're looking at China strategies, a popular arbitrage opportunity is take a look at kind of the AH premium and see how you can game the premium discount levels. And obviously this is using an index through the Hang Seng Index, which is looking at 50 names. There are 80 names overall in the broader indices that are dual listed, is what the name called, and they don't necessarily always have a premium or always have a discount. That they do fluctuate over time. Another very interesting point, which is around technology. Left-hand side here is a survey done by McKinsey, and it shows the willingness for you to share data in exchange for some type of convenience. So maybe I'm willing to share my annual income, and maybe I'm willing to share my GPS location always on my phone in exchange to maybe I can order food quicker on my app, or maybe I can do whatever online quicker. And China stands by far the number one in the world, and US is somewhere in the middle. So what did that translate to? I think it's also a little bit of the national mindset of the Chinese people. As a socialistic, communistic party, everything is kind of shared and equal. And so a lot of these data, from a company perspective, you can also acquire these data relatively easily. So what we do as investment strategies, we do go out there in China. This is also the market where, just second to the US, for the most available alternate data sets we can buy and source. So we will buy these information and we'll kind of convert them into investment insights, some of which I'll show you in a bit. Less on investments, more on coronavirus, but they're kind of related. So that's kind of one interesting perspective for a systematic investment strategy. Now, another interesting perspective for systematic strategies is you think about how we trade in a quantitative strategy. You always want breadth. Breadth is the number of bets you can apply for a single idea, right? So if you apply, it's kind of similar to, say, if you're the house on a roulette table, and you only make one bet, then the idea is you probably have 2% chance of winning. But and that 2% chance is very unlikely to get realized. But if you have 10,000 or 4,000 or 5,000 bets occurred, the likelihood of you making that profit, realizing that 2% being hit on a house, is actually quite high. Not quite high. It's actually higher for you to actually realize them. So that's the same concept of breadth. Like the number of times you can apply your idea on different stocks and realizing those ideas is actually quite essential to generate high information, high Sharpe ratio type of strategies for a systematic perspective. So let's compare a couple of different markets. So this is just looking at the diamond dots, which references the right-hand side column. So looking at U.S. large cap, obviously you think about there's a huge amount of U.S. stocks, including penny stocks, that are listed in the market. But if you just screen through minimum $5 million US average daily volume as a minimum threshold for what's tradable, you get roughly 25 to 3,000 stocks out there, 2,500 to 3,000 stocks for the U.S. all cap market. And that's the most breadth you can get. As such, we have a U.S. only model in our team. And you look at emerging markets, overall is roughly 2,000 stocks. And you look at Japan, is about 800 stocks. And China A has roughly 4,000 listed equities at any given day. You screen by minimum liquidity, it's going to screen through to roughly 2,500. So 2,500 is a huge amount of breadth. It absolutely justifies a standalone trading strategy in its own regard. You couple that with more unique localized data that you can obtain in this market, evident on the left-hand side here, then you can build something that's truly remarkable and quite unique in this market. And the sum of the data that we have here. So for every, there's a Great Firewall of China. So for every cool, interesting, successful tech company or software company or SaaS company, there is something exactly similar in the Chinese version. So there's WeChat, there's Didi, which is the Uber, there's Baidu, which is the Google, there's Alipay, which maybe it's like Venmo type. So there's definitely a bunch of these interesting data sets that we work with. Transaction online, offline, all these we have as well. And so I think this is a great segue for me to talk a little bit about what we're seeing from a alternative data perspective, how the China economy is progressing in light of the recent COVID-19 developments. So one thing people worry about, domestic consumption, right? So bottom left-hand side here, this is just looking at credit card transaction through UnionPay. UnionPay is the largest credit card provider in the world. They have obviously a huge customer base in mainland China. And so what we're doing here is compare the year-over-year change between each year's Chinese New Year. Obviously, Chinese New Year land on different days every year. So it's based on the moon phase, agrarian calendar. So the way you're gonna kind of understand it is at point 0 is Chinese New Year day. So this year it was January 20, 25th, 26th, I kind of forgot. Last year it was like February 8th, February 9th. So it changes every day, but we're comparing every single line, every single year to that day, and plus minus 30, 40 days from that day. So you can actually see kind of the transaction pattern from each Chinese New Year in the last 5-6 years. And so you can clearly see the very bottom line, which is the green line. I know the color is a bit fading. That's this year, which is it's you see a little bit increase at the start of March, but it's still very, very volatile recovery. And if I actually break it down by sector, what type of consumption is leading the recovery, what is being really suppressed still, it's IT products, so cell phones, communication products. It's real estate that's recovering actually quite well. Everything else is quite weak. Materials weak, industrial activity is very weak. Obviously, industrial activity and materials don't quite relate to credit card transactions, so the sample size is quite weak there, but very weak in hotel booking, very weak in airlines, very, very weak in luxury spending. So, certainly corroborates what we're seeing already. And you think about right-hand side here, there's the foregone retail sales, just year-over-year comparison. Now, the figure is certainly not important because that's really a sample size based on the data set we have. But just look at that spread between the teal and the yellow. Only about 20% of kind of retail sales are used. Foregone 80% of the retail sales has occurred on a year-over-year basis. So these are run as of yesterday. I just pulled them from yesterday. And then sector breakdown, I talked a little bit. So information technology, real estate, the top recovery in the latest trend, as well as communications. And then, discretionary names, the worst in terms of the recovery. And so from a year-over-year percent recovery perspective, it's still only about 30-40% in the best performing sectors, so which is in real estate and infotech and communications. Another perspective, instead of consumption, on industrial activity. Okay, so we do a couple ways. We have truck fleet GPS data in China, as well as just regular vehicular GPS data. So we're looking at changes in transport congestion. So congestion. So if big city, tier 1 cities, are always going to be traffic. If you live in Beijing, it's even way more. So just looking at the purple line in this case will be 2020, and we're looking at still very, very little change in congestion level. So certainly hasn't really recovered. You see some level of recovery, but it's still super low compared to years past. And just look at Wuhan and Hubei province is just resuming work just this week, right? So certainly a lot of this is going to be a slow and painful recovery in terms of production. Another one is just looking at workforce. So instead of looking at truck fleets, I'm looking at all vehicles on the left-hand side here. And this is cutting off as of March 10th. So this is the flow charts. It's kind of like similar to candlestick concept. So where the average is for the latest is really kind of in between here, which is only about 60% recovery. So here, this is an index level. So definitely quite low in terms of inbound traffic for major tier 1, tier 2 cities. And then on Baidu, you also get these pretty interesting heat maps where you can see on the top right-hand side, this is Pudong Lujiazhu, which is a financial district for Shanghai. Definitely a gradual increase in human concentration versus bottom right-hand side, you see a little bit of recovery in Ningbo, which is more a big factory site for many of the materials and industrial companies here. Yeah, and then that's really kind of a couple of interesting tidbits I've had. And I should kind of just bring it back to all these perspectives. We do look at kind of how these correlate to individual companies' expected fundamentals and earnings. And these are the ways to which we garner kind of, I would say, more direct and more immediate insight, and we'll implement them in a systematic fashion for investing. And I would say, A-share spaces where the average active manager will beat the benchmark by 3% to 4% per annum in the last 6-7 years. So certainly it's it's an easier market compared to, let's say, U.S. large cap from an alpha perspective. So it brings just more competition, and you do need, it is one of the markets where it does make sense to go active, and you do need to use all these type of technology at your disposal for a superior, more orthogonal, differentiated alpha generation. Cool. That's all I have today. Any questions? Can go anywhere. Yeah.
Just curiosity.
Yeah.
Why real estate in terms of recovery? Do you have a theory behind that?
So, yeah, we were looking at, so we even broke down to particular home sales figures. Home sales is still a little bit weaker, but certainly is only 80% weaker year over year. So I think it's a little bit about opportune timing. So a lot of people are still thinking, okay, maybe there's overall impact on real estate value, and I can take the opportunity to go in and transact. Maybe some people have cash flow needs and they just dispose of real estates. But yeah, that's where we see pretty interesting in terms of just pretty like unaffected trajectory in terms of real estate spending. Yeah.
Can I see slide 19 real quick?
Yeah.
Thanks. So can you run through the high breadth again and the difference? Obviously the China shares have a significant difference there.
Yeah. So the breadth argument is number of liquid stocks, which is indicated on the right-hand side. These are the diamond dots. The bar charts are the average daily volume from an entire market perspective. So, from a quant perspective, you want liquid markets where you can get in and out with lower bid ask, and you want a lot of number of stocks where the same idea you have can be consistently and cross-sectionally ranked, and get more statistical power when you actually trade them. So A-shares, just from just a large medium cap perspective, would already have roughly 2,500 names, and then U.S. all cap is about 3,000 names. So it's really kind of just the second most highest breadth single market perspective. So from our end, we have a very successful U.S. franchise in both large and small cap, and then we also have a very successful China A franchise where you can just run a standalone model and your ideas can work just on this single model. When you have cross market situations where like maybe you do emerging markets or maybe you do ACWI or DM, MSCI World, this is when you have to blend insights. Maybe you have an idea that uses credit card transaction and sift through that to get US consumer stocks. But what about Europe? What about Japan? Then you have to kind of stitch different data sources together, and that by the design will introduce some standard errors to them. And that's really, or you have to introduce kind of cross-border thematic plays where maybe it's country industry effects that actual impact on your overall alpha forecast power. So that's where that comes into another additional dimension you have to take into consideration. I would say high breadth works very good if you just play on single country stock selection strategies, right? So that's where we see these two being the best.
Appreciate it.
You talked a little bit about just now the alternative data sets you're using. Can you talk a little bit about the types of technologies and models you're using to analyze and assess those data sets?
Yeah. So so a big part of what SA what we do since 2009 is really on NLP, so natural language processing. We process over 8 languages at this point. A big part of obviously is simplifying traditional Chinese in this particular market, and the approach changed from a bag of words approach to really you can see the dictionary, you just conduct supervised machine learning and have them come up with, okay, you maybe give them 40 good words, 40 bad words from a sentiment perspective, and then over time you train them to target positive negative sentiment as a result, right? So that they will evolve over time and pick up specific dictions and colloquial usages based on the different corporates you're training on. So for example, for this one, we're training on these retail block site, and you think of these, they're like Motley Fools or Zero Hedge. So these are very retail type of websites, but they get a huge ton of participants and volume. And obviously the verbiage used there is completely unfiltered. So you'll see people cursing there. You'll see people saying like this company is garbage, or a bunch of liars. You never see that in a broker report environment, right? So you have to build specific dictionaries for the different types of corpuses you use. So I would say that's a huge part of what we do. And then actually, I mean, we don't do, if you talk about, let's say, credit card transaction or GPS vehicle data, it's nothing too sexy from kind of a machine learn perspective. A lot of it's just kind of simple transformation on these data. So it's more about building a knowledge graph, linking, okay, this particular geocoordinate, which company does it map to, right? You don't necessarily have that. Certainly the data vendors wouldn't know, so you're just kind of piecing the pieces together, and so you have a complete map on, okay, I want to know this rice liquor company, where are its known location and factories, and then I know the geocoordinates, now then I can target, and looking at the satellite image change on these particular locations. Same for credit card transaction. For Union Pay, they don't give you, bar ID or Bloomberg tickers for each. I mean, it's really the itemized receipt, and how do you translate, let's say, a particular location on your credit card statement into a public listed company. That's something that we do. A lot of cleaning up when it comes to alternate data, and that's kind of what we do there. So I would say heavy machine learning on sentiment component, on corpus, all sort of different corpus. In the US, we do conference call earning transcripts, a big thing we do. Obviously, various stock analyst reports, whether it's macro, whether it's specific companies, we do them as well. And then alternate data, just different transformations.
Maybe you can dive into this a little more, but is the main reason for that premium, the 8 share premium, is that it's insulated from the geopolitical risks, so it's more of its own market, so to speak, or are there more reasons?
Yeah, I would say the recent spike, and it continues to increase, by the way. I think I ran this through September last year, but it continued to increase this year. But if you look at kind of prior to 17, when Stock Connect program wasn't available, I mean, the premium was even higher, right? Around 1.5, 1.4. It's really, prior to opening up, A-shares just traded its own self. Very little people can get out, very people can come in. So it's just traded at an elevated level. And then more recently, after the Stock Connect program has opened, the expectation is A and H will eventually converge to one. But obviously that's not a univariate one, right? It's going to vary over time slightly and fluctuate. And reasons of fluctuation, I think, is geopolitical tension for the most recent case, and kind of think about external or domestic policy supports that can help with either side of that market.
And will another difference have to do with the sectors you talked about? You talked about how it's concentrated with consumer spending, right?
But kind of to clarify, the A-share and H-share, these are companies that are dual listed, and a lot of the dual listed names are state-owned enterprises. So think about the big banks in China, the big industrial companies, and that's typically what's in this particular 80 name that are dual listed.
So that, okay,
Yeah.
makes sense. That
Yeah.
would be a factor then.
Correct. Yeah. So I mean, you can just look at kind of PE multiples up here. I mean, look at MSCI China versus MSCI China A. Then you can see there is a premium. So like MSCI China typically trades around like 13, 14, and then China A trades a little bit higher, like 10% higher, typically.
Do you find any correlation between the overall sentiment of a company and their performance in the Could you repeat the question?
Yeah, so your question is there any correlation between sentiment of a company and the equity returns over the next few days? Short answer is yes, and certainly depends on the type of sentiment we measure. And sentiment we define it as key influencer behaviors in a particular market. So for A-shares, it can be local brokerage firms that are influencing how local people trade, local institutions, local wealthy people. They typically will get access to broker reports, to these retail block side and platforms, to foreign brokers who are influencing the key thing about, I forgot to mention, for investors, this is about 8% for investors. These are basically, these are free float adjusted, by the way, that's why it's higher. If it's overall market cap, it's 3% or so. So different cohorts will influence the sentiment of different behaviors. And so we do. And they vary. So for example, for the retail platform, most measures are pretty quick, like 2 weeks to 2 months. And then for local brokers is 3 months on average, and then foreign brokers is 3 to 4. Yeah, so it does vary a little bit. I mean, it also depends on your construction, your signal construction. We run mostly long-only money on our platform. We run about $6 billion on China A dedicated strategies, so we want to make sure these things are tradable for us. Certainly, we have hedge fund implementations. Those are not, those don't have such a high rolling period, so we can get those in and out pretty quickly.
Is there, for the A and the H shares, are there different disclosure requirements for each share class, so that people in Hong Kong have a maybe information advantage over the people trading the A shares, at least historically?
That's a good question. So surprisingly, you will find A shares are more transparent than H shares. I would say, okay, caveat that. I would say the one difference is H shares adopt more US-centric type of styles in the sense that there are oftentimes earnings calls, earnings transcripts where they can, you'll be at a meeting like this where investors can ask questions. A-shares is like, that doesn't quite exist yet, but A-shares does, like the regulation does stipulate tons of disclosure. So you actually get more, I would say, direct feedback to A-shares. I think it's also a product of the investor base. Think about the average daily volume. 80% of A-share volume is driven on a given day by retail trading, whereas you go to H-shares, it's the flip side. Only about 20% is driven by retail trading, especially it used to be higher in the early 2000s, and now it's way low. Yeah, so I think it's a bit of that.
So would that contribute then to the, like you said, the average active manager has a much easier time outperforming the A-share market, because maybe there's not an information advantage or disadvantage, but the group of people trading are trading based on different
different hypotheses, different metrics, different investment horizons.
So would you expect to see that go away, or over time? I mean, do you expect?
As the market become more sophisticated, certainly. Like we've been doing emerging market investments since 2008, and the initial years our realized IRs like 3, high 2s, and then they eventually reach asymptotic level at like 1.5. I mean, we expect similar conditions for A-shares as well.
Can you comment on, because this goes to information advantages, on sort of the prevalence of insider trading within China? There have been some articles to suggest that it's fairly a little higher than it is here, except for the
Yeah, I mean, I think it's certainly there. It's not something we can systematically capture, nor is it legal for us to do. So we don't really do it, but we do see, what's interesting, kind of related, but maybe a bit off tangent, is there are a lot of these rumors in the Asian markets, like, oh, the CEO got kidnapped, or he disappeared for 2 months. What's going on? He's being jailed, or what's going on? And all these rumors actually will cause huge panic in retail behavior. Panic buy, panic sells, both direction. And that's one of the metrics we do, is kind of measure over attention. So let's say on average, let's say there's only 1,000 blog posts on this particular company, on this particular site, and then maybe a spike to 10,000 or 100,000. That's like an immediate technical
reversal indicator for us. So we see that we kind of go the other way. And that's been a pretty good indicator. But yeah, I mean, specifically to insider trading, I would say certainly some, but that's also one of the stipulations that MSCI has put forth is increased transparency, increased regulatory against insider trading, against market manipulation. I mean, one classic case is 2015 when there was this huge spike and decline, subsequent crash. Over 80% of the listed companies suspended themselves from trading. And back then, it's like you just file a report, not a report. You just like go to the stock exchange website. You give them a call, say, hey, I need to halt my trading for my company for that day because of whatever made up reason. You can, and they'll say, oh, sure, no problem. And then so obviously the protected. People want to protect kind of downside corrections for their company, and then you can give it whatever reason is. Maybe there's M&A, maybe there's whatever corporate action that occurred. In 2018, it passed a new regulation, new law. It's like instead of on a notification basis, it's an application basis. You need to actually apply and you need to be granted by the CSRC, which is the SEC equivalent for China, before you can halt your stock from trading on the stock exchange. So I think certainly a lot of that will amount to increased transparency and just I mean, it's still pretty laissez-faire, but it's a well-regulated sandbox environment for trading. Yeah.
Question. So you mentioned about the impact of the coronavirus, and you do like a kind of like a short term, because right now we're still in the early stage of resuming back.
Mm-hmm.
So compared to let's say like more than 10 years ago when the SARS happens, I was reading another research article. Like they have a lot of stats showing like there's kind of like a rebound, kind of like a revenge right after the outbreak of the SARS. So after like everything resumed back.
Yep.
So I was wondering, can you put more like insight into kind of like, let's say in the next 3 months when we resume back to the normal level, will there be kind of like a rebound just like 10 years ago?
Yeah, so I mean, we also looked at the SARS implications back in 2003, and we were trading Asia strategies, not A-shares, but broader Asia markets. We had a live strategy then, and specifically it was like it occurred in March. It ended by like the peak to trough recovery is like March to August. Basically, was the entire kind of dip and recline for Asia markets during the SARS period. So I think about 5-6 months was that span. Obviously, the reach and the implications and the earnings impact back then is very different than this time. I think this time is far more reaching. But what worked for us during then is we load pretty heavily on our sentiment-driven insights. So, we certainly don't have that direct, deep insight on any given one company. So what we rely on is the aggregate intelligence on, let's say, the sell-side community or whatever source you get. And back then it was relying heavily, tilting towards sentiment-driven insights has been more responsive and higher, more accretive to overall alpha generation. So from our side is where, certainly not making drastic change in our risk budget and our kind of different level of insights. We're loading more on sentiment, certainly. It's like running towards like 60% now. And when there is because you think about on the fundamental side, forecast horizon typically a bit longer, 8 to 10 months. And what it's relying to, certainly you can use alternate data to harness that alpha, but a lot of it is still benched to consensus or benched to the actual quarterly prints, right? So in traditional finance, classical quant indicators, let's say around fundamental momentum or on quality, it's always based on published 10Qs, 10Ks, and then you'll get a couple quarters in of earnings result, and then you build a trend line, and then you establish positions that way. So it'll be too slow, right? If think about coronavirus impact, the consensus already knew, markets already pricing expected effects there. If you just trade on published results, the trajectory is not going to line up. So you need to load on sentiment where people are expecting, let's say, an earnings revision downward, plus a lot of textual negativity around the actual impact. Then you can, appropriately assign your positions accordingly that way. I think what's also interesting is local brokerage community, there's about 100 different local brokers throughout all different provinces in China, and they always have a huge positive bias. Very, very rarely you see a Chinese analyst would downgrade a stock. There was the first downgrade occurred like last year. It was crazy. So, but what they do is they'll say like this is a hold recommendation, but in the text portion they'll say very negative things like, oh, we still hold a buy rate, but there are all these negative effects we think might transpire in the company. So that's an advantage of using textual machine reading to extract these type of information, because if you just base off of numerical earnings revisions, which is the earnings revision ratio, is a very well-known classical sentiment insight that's been used since the 90s, that won't quite play through in this market.
Just curious, how much are you guys paying for the alternative data every year?
It depends on the data set. On aggregate, I can say on SAE platform, which we manage about $120 billion of quantitative assets, we pay tens of millions a year for new data. So that's, yeah. So certainly a little bit of scale at play, like for us. You had a question?
You talked about the fact that there's a huge spike in the on-site activity because everybody was at home.
Yeah.
Have you begun to see any diminution of that as people are going back to work? Or
Sure, yeah, definitely. I mean, it's like it peaked around August 28, 29. February 28, 29. Yeah. So it certainly has resumed a little bit of normalcy, but it's still pretty high. Yeah. And trading activity also suggests that as well. Yeah. So the level of churn you see.
And what you had a chart up there that showed the distribution of A share ownership.
Yeah.
Where are you in that, and what's your number? I mean, are you 1% of the hedge funds or 1% of the whole?
We would be classified as the foreign investor base, right? Because we're investing on behalf of many foreign institutions around the world. So that and the majority of the access method is through Stock Connect for us. We certainly do run money through our own QFII schemes, and we also sub-advise people's QFII if they have some. But we would belong in that bucket.
So you're in that 8%.
Yeah, we're in that 8%. Yeah.
And how big of that 8%?
I mean, we're $6 billion in assets under management. So for Asia dedicated strategies, so if you include our emerging market strategy, we're about $7 billion total. So this pie chart is what 8 trillion, right, times 70% because it's free float adjusted. So 5.6 trillion, 7 billion out of 5.6 trillion. Yeah, so less than 1%. Yeah. Yeah. Mm-hmm. Great. Thank you.